So let me present to you our next speaker. Elise Bean was first hired by Senator Carl Devine in 1985 to serve as an attorney on the U.S. Senate Homeland Security and Governmental Affairs Committee. In 2003, Senator Levine appointed her staff director and chief counsel of the committee's permanent subcommittee on investigations, which he chaired. During her tenure with Senator Levine, Mrs. Bean handled a variety of complex investigations, hearings, and legislation, including matters involving money laundering, offshore tax abuse, and much more. Investigations headed by Mrs. Bean include inquiries into offshore tax avoidance by Apple, Microsoft, and Caterpillar, undeclared UBS, and others. In 2014, Senator Levine retired from Senate, and so did Mrs. Bean. She is now co-director of the new Levin Center at Wayne Law School in Detroit. In 2013 and 2011, the Washingtonian magazine named her one of Washington's 100 most powerful women. In 2010, Mrs. Bean was selected by the National Law Journal as one of Washington's most influential women lawyers. Please welcome Mrs. Elise Bean.
Thank you very much. On that whole thing about being a powerful woman in Washington, my staff always said, well, why didn't you get this all changed then? You know, why aren't you more powerful than that? What I want to talk to you about is, let's see, how do I do this? There we go. We've talked about how nobody really knows what tax competition means. It's a term that's thrown around a lot, but I figure if it means anything, they're trying to talk about it as a healthy force in the market. We talk about Adam Smith, those are those little hands, Adam Smith's invisible hands in the market. And when you talk about forces of supply and demand for commercial goods, for private goods, you're talking about hitting a certain price. If the demand goes up and there isn't enough supply, the price goes up, supposedly the supply will then respond to it, and you're going to reach an efficient equilibrium. That's, in my understanding, sort of how some people are using that term. And then you'd think for public goods, it would be the same thing. There's a certain demand for public goods and a certain supply, and then you'd have an efficient tax rate, at least in theory. So if you need infrastructure, if you need an educated workforce, you need a law enforcement system that is well functioning, you're going to have tax rates that can support those public goods. But of course, in the reality, most multinational corporations, they don't want to pay any tax rate at all. They're all aiming for zero. Maybe they've got 5%, maybe they've got 1%, but their holy grail is to get to zero taxation anywhere. And we've now found out through some of our investigations that's exactly where they're going. There's a lot of factors that go into making something a healthy market force. And the one that I'd like to focus on, as Allison talked about a little bit too, is information, because that's what's missing. We just don't have it in the tax field. Taxes are seeped in secrecy. We have this whole culture of saying, well, nobody should be able to see your tax return. For multinational corporations, I don't know why that's true, but that's the culture out there. We're going to all keep it quiet. We don't want to reveal our financial arrangements, even when it's a corporation that's dependent upon being formed by the government and supported by the government. And I can tell you in our investigations, finding out the facts were a real battle. It would take subpoena after subpoena, interview after interview, year-long investigations, just finding out what Apple was up to. Let me tell you, that was a battle. And that's because it's impossible to find out the facts. And what I want to talk to you a little bit now is some examples of the asymmetrical information that we have available to us that makes tax competition really a hollow phrase because nobody really knows what's going on. So let's talk about individuals first. So we did an investigation, one of the early ones that we did, looking at UBS. And the reason we got into that is we had somebody walk in our door, a whistleblower, Bradley Birkenfeld, who said, let me tell you what's been going on at UBS and all of these secret accounts for US clients. We had another individual come into us from LGT. He was a whistleblower there. He said, let me give you all of these documents having to do with US individuals who have private accounts at LGT and Liechtenstein and tell you what's been going on there. Well, we started to investigate further, and we found that there was a lot of secrecy tricks going on among those banks. For example, in Liechtenstein, they'd say, when you call somebody in the United States, use a payphone. And don't use a payphone in Liechtenstein because everybody knows our area code. You got to go to Switzerland to use your payphone. Can you believe that? They have encrypted computers. UBS had encrypted computers when they would come to the United States. And they gave their people surveillance training. So you could tell if the government from the United States was onto you and how you could make sure that nobody actually got your information. We had, in Liechtenstein, they had this thing called transfer corporations, where they would say, all right, we're going to have somebody open up an account, but we don't want anyone to know. So the bank itself created a shell company, and when money was coming into that client, they would have the money go into ABC Corporation that they controlled, that had an account at the bank, and then within the bank, they would transfer the money from that account to the client's account. They called it journaling. So when that person then decided they wanted to send out their money for whatever reason, they would journal it within the bank back to their transfer corporation, which would then send it out. This is the level of secrecy that was going on for individuals. As you probably know, UBS eventually got, in part because of our hearing, we found out these facts from Mr. Birkenfeld and a lot of other ways that, through a year of battling that we got information. They came in and, to our complete shock and amazement, admitted it. They admitted it at our hearing, and they apologized for it. Well, they eventually entered into a deferred prosecution agreement with the U.S. Department of Justice and paid a $780 million fine. And the facts were that they had about 50,000 accounts for U.S. clients that had never been disclosed to the U.S. government, with about $20 billion in income that had never been declared as taxable income. And of course, they weren't the only ones doing it, so we looked at Credit Suisse, the number 2 bank in Switzerland. We looked at them 5 years later. We actually contacted them at the time and said, are you doing the same kinds of things that UBS was doing? And they said, well, yes, we are, and we're really sorry, and we're going to clean it up. We thought, okay, they're going to clean it up, and what's the point of having a second hearing right away on the same topic? But when we looked 5 years later, we found out that they had taken many, many years to close those accounts because they didn't really want to close them. So even though the situation had gone on, they hadn't quite gotten around to closing their 20,000 accounts with $10 to $12 billion of assets that had never been disclosed to the United States. Well, the U.S. government, being quite annoyed at them, made them actually plead guilty to defrauding the U.S. out of tax income and fined them $2.5 billion. And of course, the story isn't over now. Now the United States is entering into negotiations with a whole bunch of other Swiss banks, and they've offered them certain reduced penalties if they come forward. So far, 42 banks have come forward. This Migros Bank is just one example. They're sort of a mid-sized bank in Zurich. They had 900 accounts for U.S. clients that had never been disclosed to the U.S. Altogether, those 42 banks, you can go onto the U.S. Department of Justice website and see them all. Altogether, they've paid fines of about $360 million at this reduced rate. So this is, and of course, then the IRS says, well, let's have a voluntary disclosure program and see what we can get from that. Well, we've had over 50,000 U.S. citizens self-disclose their hidden accounts that they've had. They've paid back taxes, penalties, and interest worth about $8.5 billion. And we all know that 50,000 isn't everybody. The question is, how small a percentage are they? No one knows because we don't have information. We don't have it. So now let's talk about multinationals. More tax information seeped in secrecy. So Apple, that's an investigation that we did, as you have probably heard about. It took a year of battling with them to find out. And what did we find out? To summarize, and simplify, they had 3 subsidiaries in Ireland that were tax resident nowhere. One of these, the lowest most subsidiary, over a 3-year period, Apple sent them about $74 billion in global income. They sent a dividend to the next subsidiary, sent it to the next one. The topmost subsidiary got $30 billion of income over that 3-year period, and they hadn't filed a tax return anywhere for the 5 years we looked at. Nowhere. They had achieved the holy grail of taxation, 0, big fat 0, okay? So that was Apple. Nobody knew it. We don't think the IRS knew how much money was going through it. We don't think Ireland knew. And we think Ireland was greatly embarrassed. And when we talked to Ireland, Ireland said, we have a 12% tax rate. We never go below that. 12%, end of story. Well, what did we find out? They reached an arrangement with Apple where they excluded most of their income. They didn't have to report most of that income. The income they paid was really on sales in Ireland. So we think that's why Ireland had no idea that they were a pass-through for $74 billion of untaxed income. Walmart, a report came out earlier this year, not by us, but just as an interesting report. One of the largest corporations in the world, as measured by revenues. They had way over $400 billion last year. They're in 28 countries. But what did this report find out from running around the world, looking at obscure documents filed all over the place? They pieced them together. And what did they find out? That they had 78 subsidiaries in tax haven countries where they didn't even have any stores, including 22 in Luxembourg. Okay, 78 tax haven subsidiaries. Now, the SEC has a requirement for U.S. publicly traded corporations to list all of their significant subsidiaries in their SEC filings. Walmart had never listed any of them, even though, according to these documents, they had at least $76 billion in assets. Nobody knew. We don't think anyone knew they had that number of subsidiaries. Hewlett-Packard, another one of my favorites. We looked at them, and what did we discover? In the United States tax code, if you earn money outside of the U.S., it's not taxed until you bring it home. But there are many exceptions. One exception is, well, if you bring home a loan of some of that money for less than 30 days, we're not going to declare it repatriated and we won't tax you on it. Nobody really knows where that thing came from. Some people say, oh, it's an emergency if you have to bring money back for a short period of time. Other people say, oh, so they could bring their money home just before the end of the quarter, puff up their books, and then put it back out without getting taxed. But regardless, there is this weird exception in the U.S. law. What did HP do? They set up one subsidiary in Cayman Islands, another one in Belgium. Guess what happened? Loan, 29 days, back. Loan, 29 days, back. They had serial loans going back and forth for years. They ran their U.S. operation on this offshore money, $11 billion in one of those years, $11 billion completely untaxed. I hope the IRS is going after them, although, of course, we don't know. Starbucks, you gotta love their logo. There's that little Starbucks. It's everywhere. It's all around the world. What did the European Commission recently find out? In Netherlands, they set up a huge operation to roast their coffee beans and send them to their shops around the world. But they were paying virtually no tax in the Netherlands. How? They named two ways that they weren't doing it. First of all, they were buying their coffee beans, the green coffee beans, unroasted, from their subsidiary in Switzerland. Now, there weren't any coffee beans in Switzerland. It's a landlocked country in the mountains. Nobody's going to ship up their coffee beans and then ship them back out. There were no coffee beans there. But what they did is they pretended to own them all, and then they charged the operation in Netherlands a whole bunch of money so they could shift the profits, send the profits off to Switzerland, and lower their taxable income in Netherlands. That wasn't all. They also set up a shell company in London that had the ownership of their logo and a recipe for roasting beans. And what did the EC find out? The recipe consisted of a temperature. That was it. So they're paying buku dollars to this entity out in London, and they set it up so that that entity paid no taxes anywhere. Again, sucking the profits out of the Netherlands to this no-tax situation and lowering the amount of money that they pay in Netherlands, even though they had actual economic activity there. Caterpillar. That's one of the investigations we did in our last year. It was a lot of fun. I really enjoyed it. Caterpillar is a company that does heavy equipment. They do the bulldozers, the cranes, all of that heavy equipment. And the equipment itself costs a whole lot of money, and they don't actually make much of a profit when they sell the equipment. The way they make their profit primarily is they send spare parts, because this equipment usually lasts 20 years, but you have to have spare parts. And Caterpillar has worked out this amazing logistical system where they can track who's going to need parts where, manufacture them, and get them to where they're needed just in time for the person to buy the parts. It's really an amazing system. Well, their research and development to develop that system and the parts, because of course they make the parts in such a little strange little way that nobody else can copy them. So all that R&D is done in the US. That's 100% of their R&D. 95% of their senior managers are in the US. They have 70% of their manufacturing of those spare parts in the US. 70% of their warehouses are in the US and that whole logistical system. And they have 40% of their sales in the US. But where are they reporting 85% of their profits? Switzerland. What's in Switzerland? Nothing. There's no warehouse. There's no manufacturing. No, again, you're going to ship your heavy spare parts out to Switzerland? No, you're not, and they don't. There's virtually no senior managers there. They have less than 1% of their employees that are in Switzerland. And yet 85% of the profits are out there because they claim that their Swiss subsidiary works with all of their independent sellers around the world to work out marketing issues. Yeah, right. Okay, that's what we're doing. So this is the problem. Again, there is not much information. To get information about each one of these things, you have to fight like hell. You have to fight like hell to find out anything. So don't tell me tax competition is a healthy market force when you can't find out at all what's going on. Now, we have some efforts to address the secrecy problem. FATCA, on the individual level, for the first time, is requiring for the United States, not only banks, but every financial firm around the world has to report on any account owned by a U.S. person to the U.S. government. Now, there's lots of loopholes, and we'll have to see if it works, but the U.S. said they have now started to exchange information this year, and that is, I think they have 70 countries that they're exchanging information with. That's pretty good. There's the OECD BEPS project with the country-by-country reporting. For the first time, beginning in 2018, we're going to be able to get information by, supposedly, multinational corporations about where their economic activity is, where they're accruing taxes, where they're actually paying taxes. And now, of course, the complement to that is the EC is requiring at least their members to exchange tax rulings so we can find out about these sweetheart deals. All of those, and that doesn't kick in until January 1, 2017, which is actually pretty fast. But again, we don't know how it's going to turn out. The first thing is to develop this infrastructure, which is so difficult. And of course, even if we cure all of these secrecy problems, that's not going to cure the whole problem. These are figures loosely based on Caterpillar. But if you have sales of 40% in the US, but you're only booking 15% of your profits there, Europe, your sales are 26%, but you're booking less than 1% of your profits. Africa, sales 10%, less than 1%. Asia, 23% of your sales, less than 1% of taxes, of profits are reported there. Where are they all reported? The tax haven, okay? So while we may disagree where that economic activity should be taxed and how it should be taxed, and that's something that the world is going to have to work out through formulary apportionment or some other means, we can all agree the one place that shouldn't go is the tax haven where it's really not being taxed much, if at all. So that's my little discussion, and I don't know if we have, are we still doing time for questions? So I can take a couple questions if you would like to ask.